Welcome to TheoTrade. This is Don Kaufman here doing the weekend update on February 5th, 2017. We're going to start with kind of a quick review of markets this past week, but much more importantly, we're going to look at a pretty vast array of underlyings here in this weekend update. So let's jump right into it here. The S&P 500, and specifically the SPX, closes the week at 2297 in some pretty fine fashion here as the S&P's exploded to the upside on what was the jobs number, of course, on Friday. However, there's a lot more to it than really meets the eye. So the S&P's close up 16. But moreover, I like to give a quick, again, kind of look back at this week. In essence, to be able to do that, what I've done is going into Think Back, which is, once again, end-of-day data. For those of you that have never necessarily looked at this, here's the SPX, okay? You'll see the last price over here was $22.94, and that, ladies and gentlemen, was from the trading date. I backed up to last week, but it's from the trading date of January 27th. And the reason I like to do that is just to point out, well, what did we do all week? Well, it's pretty easy. What did we do all week? Well, we went from almost 95 to, 22.97. So for the most part, what did we do? Yes, that's, a 3-point move. So the S&Ps, for the most part, moved 3 points throughout the course of the week. And yet we're bombarded by this idea in the media, oh, we rallied huge. It was spectacular. We made a 3-point move to the upside throughout the entire course of the week. Moreover, the implied volatility, looking back this last week, the implied volatility was just incredibly low. I mean, again, we saw what we thought was going to be some volatility earlier in the week, and we actually traded pretty wild, earlier last week. And we're going to look, and when I say a little bit wild, the actual range that we saw on a couple of trading days throughout the past week, and again, this was Friday's up move, Thursday was a little bit more quiet, Wednesday, though, we had a decent range. Okay, Tuesday we had a range. Monday we had a decent range out there. When I say a decent range, and this is going to be much more forward-looking here. This is this coming week. Let me close up that left side bar over here. If you look, all right, a few days out. When I say, again, a few days out, the SPX now offers, again, a Monday expiration, a Wednesday expiration, a Friday expiration. So it gives us, incrementally what kind of risk we should expect. And this coming week, again, the whole week is expecting now a 22-point swing. That's it, the whole week. It doesn't say that we can't move more than $22. And by the way, I want to make this, again, abundantly clear, right? So that's $22 higher or $22 lower. So if you're looking at this like on a distribution curve, and we were sitting here right at what? 2,300, okay? It's, again, it'll take us up to 23.22, or of course down back into the 22.80 kind of handle out there. That's what you should kind of be thinking when you look at the expected moves. But that's where we're expected to be 5 days from now. It doesn't mean, can we move $40? Of course it can move $40. But at the end of the week, we're expected to be inside this, again, 22-point range. So what do we know? That's an extraordinarily low implied volatility. But the point that I'll make is there's a few trading days this past week, and again, I'm just like ultra zooming in over here. If you look at some of the trading days, we're having like 20-point swings on an intraday basis, just shy of 20-point swings on an intraday basis. So it actually makes trading, especially on an intraday basis. There was a few days this week we had some great intraday opportunities. Now, let's move away from a little bit about implied volatility. Let's move away from expected move, and let's get to kind of some of the, really the underpinnings of the market. First and foremost, I'm going to discuss one particular trade that I've already mentioned in the past, but this one really, really stands out to me, and it has a tremendous amount to do with the financials and the news that came out Friday. So I'm going to look at the XLF. And we're not actually going to be placing a trade in the XLF, although I do carry a position in the XLF. I am in a short position in the XLF. Okay, what I want to point out about the XLF is this is a 9-month daily. All right, we're going to zoom in here a little bit tighter. Obviously, this is after the election. We exploded the upside. One thing that really stood out to me, and I'd be remiss not to mention this, is on Friday morning, a tremendous amount of news came out that drastically impacts the entire future of the financial world. And again, we're not talking about the jobs report. We're talking about, okay, ultimately, and all politics aside over here, they're looking to repeal, okay, very large portions of the Dodd-Frank bill. Now, the Dodd-Frank bill, and I'm giving you kind of my own, interpretation of this, it was massive changes. And after, the markets crashed in '08, there were massive changes. I was working in the financial industry, and the Dodd-Frank bill had drastic effects specifically on me. I ran the education division at the time of TD Ameritrade, and it was huge. I mean, you couldn't even mention anything, much less trade certain products at that time. To see that there's going to be, repeal of huge portions of the Dodd-Frank, that's one aspect of it. The other aspect, though, is they're talking about basically doing away with the sweeping changes that were supposed to come April 1st. That's this year. They were going to have a fiduciary rule put in place as of April 1st, again, of 2017. And it looks like that is no longer going to happen, which really, I mean, just wide opens the door massively for the financials, because all of a sudden they don't necessarily have to adhere. Now, we don't know what those changes are going to be yet to the Dodd-Frank, but there's specific rules like, the Volcker rule that doesn't allow proprietary trading of the banks. What that basically means is, like, if you're Bank of America, okay, Bank of America, you can't do whatever you want to be able to do. You have to actually adhere to the, Volcker rule, which is part of Dodd-Frank. And that particular rule says you can't take big directional positions in stuff like the S&Ps. And all they can do is make markets in there, but they can't take directional positions, right? They have to do what's called bona fide hedging activity. So where am I really going with all this? All right, and all the regulatory mess out there, where am I going with it? You have to recognize, and now again, we're looking at Bank of America specifically, which looks identical to the XLF chart, right? So you go back and forth, and there's one thing that really stands out to me in looking at this. And again, I'm not a big market technician, but every piece of that news has already been priced in. Ain't no other way to tell you. Every piece of good news has already been priced in to the XLF, to Bank of America, and to every other financial on the screen over there. Okay, sure, the financials rallied a bit, but even more importantly, okay, I'm actually showing you Friday's trading session where they gapped up. But the interesting thing about Friday's trading session is the financials didn't per se gap up so much on the Dodd-Frank repeal kind of news. And again, we're not exactly sure what's going to happen yet. They were moving up based on the jobs number predominantly. And it really resonates with me when I think about, wait a second, they're talking about repealing this. Obviously, it already priced in. And I want to reiterate this stance that everything that could have happened that was positive to the financials ultimately has happened. The only other thing that can basically happen is if interest rates would continue to appreciate to the upside, which could actually be bad for the economy, but if interest rates really started to explode, then, okay, financials could have some room to run. But right here, right now, number one, it doesn't look like interest rates are going to take off to the upside. But I can't stress enough, you would have expected an explosion of the XLF to the upside on this news. Yes, it moved up 2%. From where I stand, though, I'm looking at this and going, well, it was even higher a couple of weeks ago. Thing can't get out of its own way. It's going to be incredibly important to watch the XLF this coming week. As, again, I don't think enough people are keying into how these sweeping regulation changes are going to impact, again, Bank of America and so forth to the positive, and yet the stock didn't break out. Okay, you would have expected a massive breakout. Again, every piece of good news is being priced in over here. And I'm going to reiterate a trade that I actually have on. I have a bearish position on Bank of America and a bearish position inside of the XLF. And the Bank of America position, for those of you that have no idea, I'm not just going out there. Could I just short Bank of America? Sure. Sell a couple hundred shares. But, all right, hey, listen, that could have a lot of risk. You want a lower risk trade? Come in here, go about 40 days out. Okay, it's only a $23 product. Close up this left side bar. And I'm going to just buy an in-the-money put. That's it. I'm just going to buy an in-the-money put. Why am I going to buy an in-the-money put? I don't want to pay a lot for time decay. Now, I don't need no stinking time decay. I want the delta of the in-the-money put to be right around, you know what, in this neighborhood over here, I mean, these will be just fine. That 87 delta will do me, but really, I want it to be right around that like 85, 90 delta. But the reason I'm using this in the money put, it's giving you a tremendous bang for your buck. So $2 and basically 86 cents. So the trade will cost me $2.86. Now, you're not really paying anything for time because the trade is intrinsically worth almost what you're paying for it. Okay, and when I talk about like intrinsic value, that's the real value of the option. You can pull it up over here. The real value of the option is basically $2.71. You're paying about $2.86. So is there a little bit of time value being priced in here? Yes, but it's relatively nominal. If Bank of America rallies massively, what are you going to lose? The most you could possibly lose is $2.86, but you'd have to fall asleep at the wheel. Bank of America would have to rally, $1, $2, $3 for you to lose. And you wouldn't even lose the full 287 in here. But if Bank of America sells off, you're getting almost dollar for dollar bang for your buck. It's a smart risk reward. And that's why in this case, somebody says, well, why don't you use a spread? Why don't you use this? Because there could be, pretty phenomenal downside opportunity in a stock like Bank of America that for the most part, come on, you got to think about this regulation change over here. The stars are completely aligned. Meaning it couldn't get any better. It doesn't even matter about the management of any of these companies anymore. You have interest rates that have gone up. Great. You've got ultimately a political system that is gearing towards the financials. Fantastic. They're wiping away the fiduciary rule, which was going to open up the banks to huge litigation possibilities years down the road. Again, every star is aligned, and it didn't break out to the upside. It's going to be important to watch the financials in the week to come. Let's move forward. Away from financials over here in the Bank of America trade. One of the ones that's really caught my eye lately, and we're going to get to some specifics of, a few of the stocks have had earnings. But one thing that's really caught my eye lately happens to be the XLE. This is the energy sector ETF. And the energy sector ETF ultimately has traded from this 78 level, slipped fairly hard back down to the 72. Why is that catching my eye? Because compare it, for instance, to oil. Now, oil, what has it done? Oil's actually slightly bid in the exact same time frame. It's got oil actually rallying, and for the most part, everybody in the oil industry not doing so well. And I'll go even more specific over here. We're going to look at ExxonMobil, which is getting whacked back. This is, for the most part, right around a 9-month low. What is not great about this, and again, I am in fact, looking for a more bullish opportunity over here. But this happens to be a 3-year chart, and you can see ExxonMobil, it hasn't been back to these levels. You got to go back into, March of like 2016, just about a year to see it really having broke between these levels. But that's once, twice, 3 times. It does look like ExxonMobil is going to continue down. I'm going to be looking for opportunities in ExxonMobil, and I'm just giving you a heads up now that we're going to be looking for opportunities. The issue with ExxonMobil, this is why you do not want to take a bullish position just yet. This is it's pretty scary, but the implied volatility, is for the most part at one of the lowest instances that it's been any time in the last year. That's an IV ranking of 3%. That, ladies and gentlemen, is not a bullish connotation right now for the energy sector itself. So the ExxonMobil is down to a 3%, or it's 3 ranking over there, and the XLE, the energy sector itself, it's not far off. It's 5%. It's incredibly low implied volatility, which is indicative of there could be a heck of a lot more risk to come out there. It's unusual to see products that are falling stay in such an incredibly low implied volatility range. All right, so we're going to be watching the financials this week. The XLE, in the XLE, again, for all intents and purpose, I'll throw this out here. I do have a short position in the XLE as well, and I've actually been riding it down over here. It does appear like it's going to have some more downside, but if it starts to come back down to like this 68, level, I may get a little punchy and start to look for some opportunities at that point. Now, continuing on, let's get to, well, the stocks that everybody's interested in. The Microsofts, the Facebooks, the Apples, the Googles, the Amazons over here. Why not? Okay. If you take a look at the NASDAQ, so we're just going to go, I'll pull up the NASDAQ the easiest way. Q. What does it stand for? The NASDAQ. The NASDAQ is just about to breach all-time highs. I mean, I've said that how many weeks in a row over here. It's about to breach all-time highs. But there's one thing really surprising about this. And as the NASDAQ is about to breach an all-time highs, I want you to go take a look at Microsoft, because Microsoft tends to fall off everybody's radar screen. Okay, since its earnings, it's in a downward spiral. It did catch a bit of a bid. That means they bought it on Friday. This looks like downward spiral kind of territory over here. Obviously, there's some really heavy volume too. And again, that's days after the earnings. So Microsoft slipping fairly hard. Then I went and take a look at Facebook. Now, Facebook, this is after the earnings. All right, you're looking again, all-time high. Slips a little bit though on the trading session back to the 131. Nothing yet inside of Facebook makes me think it's going to continue to slip to the downside. But I want you to look again at a number of the other major tech stocks over here. Now, Apple having an explosive rally, holding that rally over here. It's Google that is quite interesting to me. Google slips hard off earnings, can't get out of its own way for the last couple of days. Amazon, okay, slips hard in its earnings. Technology is also going to be a key area to watch this week. So for the most part, the financials and technology are your two biggest sectors over here. And we are displaying a degree of weakness, all right, in a number of key tech stocks. It's financials, though, that really led the S&Ps, again, on a percentage basis. If you looked at Friday's rally, okay, on a percentage basis, take a look very specifically there. The S&Ps were up, for the most part, 0.7%. The NASDAQ, all right, was a little bit lackluster, only up about 0.5%. The Russell, on fire, 1.75%. And again, talking about short positions, right there, that's my single largest short position right now, happens to be in none other than the Russell, which once again, even though it had a fairly spectacular rally, wow, has that been in a tight range. What? I mean, you got to go all the way back here into, all right, really late November, early December to see how tight that range is inside of the Russell. All right, so we've gone through, again, the Microsoft, the Googles, the Facebooks, XLE versus oil over there, the Bank of America trade. We know to be watching financials like a hawk over here. Okay, Google specifically, is there going to be more downside activity this week? I mean, again, you hit into, and again, I'll open up a larger time frame in this chart over here, but you hit all-time highs, okay, inside of Google. No doubt that, NASDAQ hits all-time highs in that. And when I say fall fairly hard, again, we traded from the 860 level, okay, down into the 810 level, almost a 50-point sell-off over here. We'll see if there's a bit of follow-through. Again, what should be a bit alarming to some people is, again, these stocks are falling, but their implied volatilities are not picking up. It's like one of the worst situations that you want to be in when you see a stock getting hit and the implied volatility just shrugs its shoulders, okay? There's really no opportunity. Even if you think we're going to bounce in here, there's not great opportunities to be able to get bullish on many of these stocks. Again, because their implied volatilities are not picking up over there. It's, again, you could be stepping into some fairly extraordinary risk. Overall, volatility of the S&P 500 remains incredibly low. Again, you got the sectors to watch. You got the Bank of America trade. Thanks, everybody, for joining us this weekend here at TheoTrade. I'll be back in the TheoTrade chat room all throughout the course of this week. Have a great weekend, everybody. Bye-bye.